Welcome to this comprehensive guide on the basics of the Indian stock market. Whether you're a beginner curious about investing or someone looking to understand how the market works, this video is for you. We'll break down complex concepts into easy-to-understand terms, helping you gain confidence in navigating the world of stocks and investments in India. By the end of this video, you'll have a solid foundation to start your investment journey and make informed decisions. Let's start with the very basics. What exactly is the stock market? At its core, the stock market is a platform where buyers and sellers trade shares of publicly listed companies. Think of it as a marketplace, but instead of vegetables or clothes, you're trading ownership stakes in businesses. When you buy a stock, you become a part owner of that company. So why should you even consider investing in stocks? The primary reason is wealth creation. Historically, stocks have offered higher returns compared to other investment avenues like fixed deposits or real estate. Investing in stocks also allows you to participate in the growth story of companies and the economy as a whole. It's a way to make your money work for you. Now that we know what the stock market is and why it's important, let's look at the key players and regulators that make it all function smoothly. The Securities and Exchange Board of India, or SEBI, is the main regulator of the Indian securities market. SEBI's role is crucial. It protects the interests of investors, promotes the development of the market, and regulates its operations. They set the rules and ensure fair practices. India has two major stock exchanges, the National Stock Exchange, or NSE, and the Bombay Stock Exchange, or BSE. These are the platforms where stocks are actually traded. They provide the infrastructure for buying and selling shares efficiently and transparently. To trade on these exchanges, you need a broker. Brokers act as intermediaries between you and the stock exchange. They execute your buy and sell orders. Additionally, when you buy shares, they are held in a Demat account, which is like an electronic safe. This account is maintained by a depository, such as NSDL or CDSL, ensuring your shares are securely stored. Feeling ready to dive in? Let's walk through the steps to get started with stock market investing in India. The first step is to open a Demat account and a trading account. A Demat account holds your shares in electronic form, while a trading account is used to place buy and sell orders. You can open these accounts with a registered stockbroker. The process usually involves submitting KYC documents like PAN card, Aadhaar card, and bank statements. Once your accounts are set up, you'll encounter different order types. A market order buys or sells shares at the best available current price. A limit order allows you to set a specific price at which you want to buy or sell. Understanding these helps you control your trades. Now let's explore some essential concepts that will help you understand the market dynamics better. In the stock market, you'll mainly hear about equities and derivatives. Equities are simply shares of a company, representing ownership. Derivatives, like futures and options, are more complex instruments whose value is derived from an underlying asset, like a stock or an index. They are typically used for hedging or speculation. Market indices provide a snapshot of how the overall market is performing. When deciding which stocks to buy, investors often use two main approaches: fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's financial health, management, and industry outlook to determine its intrinsic value. Technical analysis, on the other hand, studies past price movements and trading volumes using charts and indicators to predict future price trends. Investing in the stock market comes with both risks and rewards. It's crucial to understand both sides of the coin. The stock market can be volatile, meaning prices can fluctuate significantly in short periods. To mitigate risk, diversification is essential. Don't put all your eggs in one basket. By investing in different companies, sectors, and asset classes, you can reduce the impact of a poor performance by any single investment on your overall portfolio. Congratulations! You've covered the basics of the Indian stock market. We learned what the stock market is, why to invest, the roles of SEBI, NSE, BSE, and brokers, how to open accounts, different order types, and important concepts like indices and analysis methods. We also touched upon the crucial aspects of risk management and diversification. Remember, investing is a continuous learning process. Stay informed, do your research, and consider consulting a financial advisor before making significant investment decisions. The more you learn, the better equipped you'll be to navigate the exciting world of the Indian stock market. Happy investing!